Hello everyone, this is Mark with Semantics Research with your daily report. So today the market took a nice dive as the treasuries ticked higher, the dollar caught a bid, and the VIX spiked ahead of the CPI number that is tomorrow. Many are probably expecting a really bad number as the Biden administration stated that they expected a high ugly number, but it would not surprise me if the CPI number misses the expectations and we rally due to the fact that the market was pricing in a hot number. However, if the number is hot or hotter than expected, then it does not bode well for the markets overall, and we might see some more sell pressure. Generally, commodities and defenses perform well in a high CPI print, while tech and discretionary generally are weaker. It seems like after an initial rally in the IB period in the morning session, we were moving up on light volume and pulled offers on the ES, and the market consolidated for a while 41.10 has been a key resistance throughout the intraday. As watching the tape, you could see that there was sellers stepping in at the 41.10 level and defending that area. So we ended up having many long positions being bagged, and many longs were frustrated by this, and eventually the market capitulated. Now going into the debt to GDP, we could look at two data points. One is the federal public debt to GDP shows that the government debt has risen quite drastically over the past 50 years, from 30% in 1980 to 125% by today. This is a great amount of rise in debt to GDP. And it was, you could say this is cyclical, as it was at its lowest in 1980 when the yields were at its highest. And as the yields fell, borrowing became cheaper. So we saw an increase in debt overall in the US. We saw a drop in the debt to GDP in the 1990s with a strong labor market and increased tax receipts until the global financial crisis, which brought lower tax receipts and fiscal stimulus, as well as the pandemic in 2020, which has caused debt to rise to insane levels. The US has now a higher debt to GDP ratio than the Eurozone and China. And we could draw some parallels to the 1970s, where the US government spent servicing its high debt from the Vietnam War during this period. Although at this time we have way higher levels of debt versus in the 1970s. Now, taking a look at corporate debt to GDP, which is 40% higher than the high inflation period of the 1970s. So in the past few decades, we did enjoy a period of low interest rates for many, many years, and cheap money has allowed us to finance rapid innovation. Now, we may potentially see a period where inflation remains stubborn and debt becomes more expensive, but the question is this a new systemic change? That is quite uncertain, but as the global supply chain constraints continue to increase inflationary pressure on the global economy, and potential deglobalization and decoupling from China, as China has been exporting its deflation through lower manufacturing costs to the global economy, that may be a potential catalyst for change. It is very crucial to see how the next two CPI numbers print to see if we are truly getting inflation under control, which I personally doubt. as well as a GDP number. Also, generally when oil prices have rose in the past, it is generally highly correlated with stagflation. Now, going into geopolitics, although there are talks to reopen ports in Ukraine to fix the grain crisis, it will likely take many months before all the sea mines are removed from the area, so it could be safe enough for ships to travel through these waters and resupply key geopolitical hotspots. There are many vulnerable hotspots in Africa and in the Middle East, which is susceptible to uprisings and very highly sensitive to higher grain prices, as it is their main staple. For example, 7.1 million people in Somalia face food insecurity in the next few months as famine is looming in the horizon. Many hundreds of millions of people risk a catastrophe if this crisis is not averted. The previous year, Ukraine has exported its grain to 400 million people worldwide, and the supply has been quite constrained now. We have already seen some grumbling in these areas, which can worsen if this Ukraine war stays rather prolonged and neither side decides to negotiate, so it could lead to more turmoil in the global economy. So due to the war, we have seen higher freight costs skyrocket, and it is making a bad situation much worse. Many shipping companies have avoided this area due to the high risks, and about 80 ships are still stranded in the ports, which is down from 2,000 ships. Now, we are seeing some signs of normalization in the shipping levels in the Black Sea area, except for areas such as the Northwest and the Sea of Azov, which Russian vessels are blockading. There are now reports that Russia is weaponizing Ukraine's grain supply by stealing grain in the occupied ports, as satellite images have shown. Grain is being illegally diverted from a place like Kenya, which is suffering from much drought and hunger, while Russia denies all these claims. It is likely that we will see higher food prices later this year, and as the supply dwindles, as well as reports from U.S. farmers that rising costs of production and bad weather will affect prices later on, as this effect in price tends to lag. Now, we've seen the dollar go up slightly before the initial jobless claims were released, then rallied after the report was released to a negative surprise of 229,000 compared to 210,000 expected. Most of the other main assets ended negative today. Now, payrolls came in stronger than expected, as reported by the BLS, which is largely due to seasonal adjustments, while the jobless claims report was recently released, signaling that we are seeing cracks in the jobs market with a slight uptick in initial claims, the largest jump since last July. The 4-week moving average was 215,000, with an increase of 8,000 from the previous week's revised average. Now, going into natural gas, we saw a nice recovery in the previous day's losses in natural gas, as the LNG terminal explosion in Texas will delay U.S. imports for 3 weeks into Europe, which accounts for 20%. The U.S. Energy Information Administration expects natural gas prices to increase again this month and remain high throughout 2022 because of a lower than average natural gas inventories. Then in 2023, they expect natural gas prices to go back down as production increases and supply ramps up. Now we will go over a supply shock, which is a sudden increase in costs in an important part of the economy. Like in 1973, when a tripling of world oil prices by the Organization of Petroleum Exporting Countries, or OPEC, in the aftermath of the 1973 Arab-Israeli War. This type of situation gives central bankers no really good options. The thing is, the shock shifts the aggregate supply curve up and to the left. In response, central bankers can expand demand to keep shock from causing recession, keeping production at potential output at the price of accelerating inflation, or contract demand to keep the shock from adding to inflation, thus causing a deep recession. In practice, central banks usually split the difference. This combination is called stagflation. We are seeing remarkably similar situation occurring today with oil prices skyrocketing due to the supply of oil not meeting the demand, which is a cause of this adverse oil supply shock. This supply shock can cause recession, and central bankers would lower interest rates to stop this from happening. But we have already seen incredibly high inflation from supply chain destruction from COVID and the crazy money printing by the Fed. So the Fed now must deal with the oil supply shock being recessionary on its own, and already incredibly high inflation we have now, playing into the classic setup of stagflation, which as it has occurred in the 1970s. Now the Fed must choose between fighting skyrocketing inflation and deep recession with high unemployment, or letting inflation get even more out of control, which can be even more disastrous. And that is it for today. I want to thank you all for watching, and be sure to check out the link in the description for more updates on the Twitter and Substack. We will be releasing many more content in the weeks to come. And thank you. This is Mark with Semantics Research, signing out.